Part 3 of our Chapter 12 lecture focused on what's known as accrued income and deferred income. Accrued income refers to income that has been earned but not yet received and recorded. Again, income that has been earned but not yet received and recorded. So we're going to make an adjusting entry to make sure any accrued income has now been recognized and recorded in our accounting records. For example, we have Whiteside Antiques accepted from a customer a 4-month 15% note for $1,200. So a client owes us $1,200. We made them sign a promissory note agreeing to pay us back the amount owed plus 15% interest in 4 months. Now our accounting period ends on December 31st. So we need to recognize the amount of interest that we have earned on this note by the end of the accounting period. Understand that we won't receive the actual interest until the note matures. However, the accounting rule says to recognize any revenue earned by the end of that particular accounting period. So interest again equals principal times rate times time. We take 1,200, the principal amount. The rate was 15%, and our time factor would be 2/12 because the note was issued on November 1st, and our accounting period ends on December 31st. From 11/1 to 12/31 is a 2-month time period. The 15% is the annual interest rate, or the rate for an entire year. So we take that times 2/12 times the principal amount to get the amount of accrued interest on this note. So the amount of interest we've earned by the end of the year would equal $30. Now that you've done the calculations, we have to make the journal entry in order to recognize and record the amount of accrued interest that we've earned. You would debit interest receivable, showing the amount that's owed to the actual company, and we're going to credit interest income or interest revenue. Okay? So now we're going to make one last type of adjustment for a topic known as unearned income or deferred income. This takes place when cash has been received before the income has actually been earned. For example, think about subscription income. Maybe you purchase a magazine subscription and you pay for it for 2 years in advance. For the magazine company, that is going to be what's known as unearned or deferred income. Or maybe a tenant pays their rent for 6 months in advance. For the landlord, that is known as unearned or deferred income because the payment was made before the rent was actually earned. Okay? So we'll go through an example of how to account for what's known as unearned or deferred income. On November 1st, Perez Realty Company rented a commercial building to a new tenant and received $36,000 in advance to cover the rent for 6 months. So a tenant paid the landlord $36,000 in advance to cover rent for a 6-month period. Upon receipt, the $36,000 was recorded in the unearned rent revenue account. So you would debit cash for the $36,000, credit unearned rent revenue for $36,000. And I forgot to mention that unearned rent revenue, or anytime you have unearned income, that is a liability account. And that's because we have an obligation to rent out our facility for the next 6 months to this tenant because they've already paid their rent in advance. So when you have deferred income or unearned income, that is known as a liability account. Now the question is, how much of the unearned rent revenue have we earned by December 31st? Well, look at it this way. The $36,000 covers rent for 6 months, meaning that we're going to earn $6,000 per month in rent. From November 1st to December 31st is how many months? That's correct. It's 2 months. So we're earning $6,000 a month for 2 months. We've earned $12,000 by December 31st. So once we've actually earned it, you're going to reduce the liability account unearned rent revenue by $12,000, recognized rent revenue in the amount of $12,000. So again, when you have unearned or deferred income, again, those are liability accounts. Once it's been earned, you're going to decrease the liability account and you're going to increase your revenue account. Well, that will conclude the different type of adjustments we're going to cover for Chapter 12. Be sure to review all of the video lectures for Chapter 12. Complete your Chapter 12 homework as well.